On our channel, we quite often talk about taxes and different types of taxation, but we also focus on different countries and how it works for the specific countries. In today's video, let's dive a little bit more into 5 different types of tax systems and what do they actually mean. Hi, my name is Tiana, and I've been a part of the strategy team for years, where we have been helping high net worth individuals go where they're treated best and create holistic plans that will be all about immigration, taxes, and their asset diversification. As I've mentioned, today we will dive into 5 different types of taxation. So the first one we will talk about today would be the progressive tax system. This is the one we probably like the least, but let's talk more about it. What it actually means to be in a progressive tax system is that the taxes will increase as the income increases itself, which would mean that those with higher income are more likely to pay more taxes. Countries that would be practicing this type of taxation would be the highest tax countries, such as US, Canada, a lot of European countries. These are places where a lot of people are not happy with the tax system, but this is the most common one in the world. Generally, if you want to become a tax resident of countries with the progressive tax systems, you usually have to spend 183 days in the country. But of course, that is not the only requirement. You have to have closer connection to the country, and that is what is going to determine if you are actually a tax resident. This actually entails that it is most difficult to get out of these tax systems because for their exit, they will require the most work to be done to actually declare yourself a tax non-resident. The tax system we will talk about today would be the flat tax system, or also known as the lump sum taxation. What it actually means is that some countries do have a set level of tax to be paid, regardless of how much income you are earning. This is not to be confused with the non-dom taxation as well, but some non-dom tax systems will have the flat tax incorporated in it. Some countries that I can take as an example would be Italy and Greece. Each one of them has a 100,000 euros flat tax, which entails that no matter how much money you earn, your tax is always going to remain at that rate, the 100,000 euros. There are other countries that also say that they have lump sum taxation or flat tax. One of them is Switzerland. However, Switzerland is not your regular lump sum taxation. They do have different rules per canton, so it's going to be a lump sum, but depending on your lifestyle, how much you earn, where you live, which canton you're in, your lump sum is going to be changing. When it comes to the criteria to actually become a tax resident of a country with a lump sum taxation, it's going to be somewhat similar to the progressive tax system. What it means is that you would have to live in the country for 183 days. In some cases, it would be less. Let's say in Switzerland that I have mentioned, if you actually live there for 90 days and you have one of the permits like L, B, and C, you would immediately be considered a tax resident unless you can show that you have closer ties to another country with a double tax treaty. So this is why it is important to know every aspect of the tax system in the country in order to determine if this is the right choice for you.
Just a quick timeout to tell you that if you want help legally reducing your taxes by moving yourself and moving your business and moving your assets offshore, that's what Nomad Capitalist is here to do. You can go to nomadcapitalist.com/apply and you can plug into our team as well as a network of a lot of experts around the world. We have people in many, many countries that will help you diagnose on a global level how to reduce your taxes, not just income taxes, but the unknown taxes, things like estate taxes, things like dividend taxes, taxes you may never have considered. Some people move to what they think is a tax-free country and they actually increase their tax bill. It doesn't happen a lot, but those are the kinds of things we can help you prevent from happening. We can help you get a comprehensive plan that's built by our network of experts and years of experience. It's a one-stop shop for legal tax reduction. Go to nomadcapitalist.com/apply to learn more.
The third tax system we'll talk about today is the most interesting one in a sense. It is a territorial tax regime. So what it means is that some countries opt out to tax you only on income that would be sourced on their soil. What it means is that if you are getting income from outside of the borders of the country of your residence will not be taxing that income. Countries like this are going to be, for example, Panama, neighboring Costa Rica, Georgia in Europe, which means that these countries will not be taxing your income if you are earning it abroad. In order to become a tax resident in these countries, of course, each country is going to have a different set of rules, but let's say for Costa Rica and Panama, you actually have to reside in the country for 183 days, and you also have to have closer connections in order to get the tax certificate. In Georgia, however, Georgia is a bit of an interesting case that has a couple of options, and the first one is very mainstream, just spending 183 days in the country and being exempt on the foreign earned income. But they also do have the option for the high net worth individuals who are investors in the country. And if you choose to invest $500,000 in the country in assets, any type of assets, you can become a tax resident without physical presence as long as you're not overstaying your time in any other country. So when it comes to the territorial tax regime, this one could be the most favorable one if you are earning your money via passive income, companies that are outside of the country where you want to reside, and mostly businesses where you don't really have to have an on-ground presence. The fourth tax system we'll talk about today would be the non-dom. Non-dom is not so common, but it can be quite similar to the flat tax system that we already talked about. What non-dom entails is that you have to know where your domicile is. In most cases, country will have the rule that your domicile is where you are born. So let's say for you, if you do have multiple passports, they will be looking at where you were born. If you have multiple passports and then you still cannot decide where your domicile is, if you had two passports at birth, then they will be probably looking at where your parents were born. So there is always different ways to determine what your domicile is. But if a country has a non-dom tax regime, what it means is that they will not tax you on any money that you don't bring in the country. So it's usually going to be remittance-based taxation. So whatever you bring in the country, you pay the tax on it. Each country will have a different set of rules when it comes to the tax rates that are going to be applied. So you should be looking at this closely. Some of the countries that would have the non-dom systems would actually be Ireland, Malta, and Cyprus, and these would be very favorable tax regimes. In order to be treated as a tax resident of one of these countries, each one of them will have a different set of rules. Some of them will require 183 days. Some of them will require no days to be spent in the country, like Cyprus will want you to be in the country for 60 days. So it would all depend on where do you actually see yourself spending time in, if there is the requirement. You would need to look at these countries closely, but they would bring you very similar benefits when it comes to the taxation. And the fifth tax system we will talk about today is the one that actually exists in only two countries in the world. Those would be the United States and Eritrea, and you have guessed right, it is the citizenship-based taxation. In a lot of countries, including Hungary, there have been talks about potentially introducing the citizenship-based taxation. As you might have heard on our channel, Australia did attempt to get close to that type of taxation, making it more difficult for those who are Australian tax residents to actually depart the tax system. But as of now, the only two countries where this is actually in place would be the United States and Eritrea. What it actually means is that if you are a citizen of one of these countries, no matter where you live in the world, no matter what is it that you do, no matter where your business is, you're always going to be paying taxes in one of these countries where you're coming from, which becomes quite difficult because if you are a US citizen and you do leave the country and you would like to optimize your taxes, you cannot do so unless you actually give up, renounce your citizenship. And on our channel, you will hear a lot about different ways to actually renounce the citizenship and what to do in order to maintain the lifestyle that you have because of the Tier A passport. For all 5 of these systems, it would be good to find out if there is maybe the specific part of the world you want to live in, if there is the need to actually have the lower minimum presence requirement, what is the minimum tax you're actually comfortable with, because sometimes for people lifestyle is more important and paying 10% taxation doesn't seem too bad compared to what they have already. So it would be helpful to consult with a legal tax professional who will be able to assist you to make these choices and actually put everything together. If you maybe have any questions, you can leave the comments down below. We'll make sure to answer. Thank you for watching. Check out our other videos if you want more information on any specific topic.